Alright, so let's talk about these funds. So this is what really makes governmental accounting a lot different from the financial accounting, because we report out all these separate funds, and that's not something that happens in regular financial accounting. So remember, we have three main categories, right? Governmental, proprietary, and fiduciary. Governmental funds are the kind of general funds that you run the government with that can't be specified as proprietary. Proprietary funds go with, belong to some kind of separate sub-entity. Again, we've been using examples: water department, electricity department. Certainly you could have a school, something like that. The A&M system has a bunch of separate A&M universities that all have their own separate proprietary funds. Things like that. And fiduciary funds, of course, those funds held in trust for somebody else. They don't really belong to the government, but because it's a governmental entity, it's holding funds in trusts to do stuff with in the future. Alright. And they don't really belong to the government. So you've got these three categories, and each one of these categories can have sub-funds, I guess, right? It's pretty easy to imagine. The proprietary fund might have a separate column for the water department, a separate column for the electrical company, separate column for waste collection, separate column for the library, right? So it's easy to imagine how this works, right? You've got three main categories, and each might have sub-columns within them. Now, when you prepare the financial statement for these three categories of funds, under governmental funds, you have a balance sheet and a statement of revenues and expenditures, kind of like an income statement, and a required budgetary comparison, right? So remember, with governments, the budget is super important, right? Because it's imposed on the government and they have to follow it. It's not like at a company in 2302 where you learned how to prepare a budget and then do a budget variance because you sold more or sold less and spent more for materials or spent more for labor. That's not how that works. There's not variance. This is how much you get to spend, and you spend it, right? So you have to have this required budgetary comparison. You have, for the proprietary funds, you'll have the statement of net position, that balance sheet, that kind of thing. You'll have a statement of revenues, expenses, and changes. And for proprietary funds, you'll have a cash flow statement, right? Because it's more, if you think about it, it's the most like a business, right? The waste department runs a business. They send out bills every month for collecting waste. They have assets that are specifically for just that. They have employees for specifically for that, just that. They have expenses. It's exactly like running a business. So, statement of cash flows. Proprietary funds just have net position and statement of changes. Again, because the money they collect in is not for the government. They're just holding on to it, and then they have to pay out the pension, or they have to pay out the repayment of the bond, or whatever that's being held in trust for. Alright, so the first set of statements are the governmental funds. First set of statements that you would have would be the balance sheet. You have to have a general fund, and for some small places, and maybe Kingsville's one, you might have only a general fund under your governmental funds. But you have to have that. You have to have a general fund. Then, if there are some other major funds that don't fall under one of the other two categories, it's pretty easy to imagine, like, you might have a fire department fund as a separate major fund, because that would be something expensive that a city would run, and it's easy to imagine that it would meet the requirements for having a separate fund. So if this separate fund you keep, like say the fire department, the police department, it could be the library, something that's not an enterprise, doesn't go under proprietary, but it's easy to imagine, okay, the fire department doesn't really make money, but it's a very large part of many cities. It's one of the most important services they provide. So it could be a major fund, therefore you might have a separate column for it. How do you decide if something gets a separate column that's not proprietary? Well, it has to have 10% of the assets in the government category. So it's pretty easy to imagine a small town like Kingsville. You know, the fire stations and the fire trucks and things, they could be 10% of the assets. And it has to be 5% of the total assets of government plus enterprise. All right? So if you have a general fund and then a few major funds, then you'll have a total column at the end. Right? So you have to have, like, you can imagine you have a general fund, right? Fire department, police department, total. All right. And then you'll have that. All right, so that's the balance sheet, right? Then you're going to have statement of revenues and expenditures. So same idea, same potential for funds. You'll have revenues less expenditures equals change in the fund balance, plus beginning fund balance equals ending fund balance. Remember, it's not about income, right? We're just tracking how much came in, how much went out. What did we start with? What do we end with? Right? That's the point. All right. So expenditures are classified by character. So if you think about income statements, right, they're going to be classified by operating, non-operating, selling, administrative. How you classify expenditures, not really expenses, right? They don't call it an expense. They call it an expenditure. Expenditures are by character. So is it current? Is it something we're spending right now, kind of like operations? In fact, I'd call it operations. But so current. Or is it the character of this expenditure to pay for debt service? In other words, paying interest on our bonds that we issued to build the road, right? Is it capital outlay? All right. In other words, did we buy a new garbage truck? Something like that. Did we build a new building? All right, so we classify it by character. Why? Because if you think back to the government-wide, we take a net position and we have to match the liability to the asset, right? So we take asset minus depreciation minus debt equals net position. So that's why we characterize the expenditures. All right. So current outlays, past spending, something that will benefit the future. That's the character. All right. Now, the thing about these fund statements is that, and again, don't worry too much about this, we're going to get into this in future chapters, but the government-wide statements that we talked about first, those two big government-wide that encompass everything, the consolidated financial statements, if you will, those are kept on the accrual basis, and the fund statements are on modified accrual, which is sort of that adjustment we make because, well, we don't really do accrual-based accounting because when do we say it's a revenue? When do we say it's an expenditure? It's easy to recognize when there's an actual sale or provision of service. That's a revenue. When I declare a tax is due, when does it become revenue? If we just say, well, when the person pays it, then that's not modified accrual, that's cash basis accounting, right? And that's not what we're doing either. All right, so we'll give more understanding about modified accrual, but just know that we have to reconcile these funds, which are kept modified accrual, to the overall two statements, which are straight up accrual basis that we're kind of used to anyway. So we gotta work on that a little bit. So there is this reconciliation schedule. Okay. So that's the government funds. Now we have these set of funds called proprietary funds, right? So, and those are the enterprises, right? The water department, the electric company, things like that, the garbage collection. So, how does it get to be a separate enterprise fund? 10 and 5% approach again. 10% of enterprise, 10% of proprietary, 5% of both enterprise and both proprietary and government. And of course, if you have some non-major stuff that don't meet the 5 and 10% rule, then they just get totaled in a separate column out there. And then there's a separate column out to the far right that totals all your other columns. Makes sense, right? You're going to have a separate column for internal service. So remember, there are some enterprises that provide service internal to the government. Sometimes, depends on the government. But if you do have that, you would have a separate fund. And of course, for the proprietary funds, you're going to have a statement of net position, which classify its assets and liabilities, current or non-current. So that should be pretty familiar. This is kind of weird though. So when you take your assets minus your liabilities, you're taking it from three categories. So you're going to have capital assets net of debt. You're going to have restricted assets and unrestricted assets. So that bottom line is not going to be, just net position assets minus liabilities. It's these assets minus these liabilities equals capital assets net of debt. These minus these equals restricted. These minus these equals unrestricted. So you got that going on. You don't reconcile to the government-wide because you actually do use accrual basis for the proprietary funds, and that makes sense because there is revenue. You do provide a service. You can recognize revenue when you provide the service or deliver the goods. You are able to use accrual-based accounting for proprietary funds. And of course, proprietary funds also have statement of revenue and expenses. It's kind of like an income statement. It includes gains and losses. It's really a lot like an income statement. So and it even uses accrual basis. So I think you'll get this pretty well. But again, you may have those separate columns, right? So it's not just revenues minus expenses equals net income. It's water system, electric company, waste management company, totals, and a total column. All right. The proprietary funds get a cash flow statement. They're the only set of funds that get a cash flow statement. And again, that makes sense, right? What does the cash flow statement do in a business? Well, it reconciles the changes in cash to net income. Because net income is accrual based. Changes in cash are cash based. So we do that cash flow statement to reconcile those so we can see, okay, do we have cash flow or are we getting all our cash from borrowing? What's going on with the cash flow? Same idea here because proprietary funds are basically enterprises, forms of business. What makes these different from the cash flow statements you're used to looking at is instead of operating, financing, and investing, the three categories of cash that's flowing through the organization, you've got four categories, again relating back to that fact that when we make an expenditure, we're going to match it to that asset and subtract it out to get that net. So we need to keep operating cash, so that's the same thing, all right? Running the business operations, reconcile to net income. Non-capital operations, right? So the financing section so basically operating, financing, and investing, the three parts of the cash flow statement we're used to. You just take that financing section and separate it out into two sections, operations and fixed assets. And we do that because servicing those debts matters when we do that net position statement. We match them up to their assets. Whereas in a business, we don't really do that. Okay, so here's a little comparison of cash flow statements. So in Accounting 2301, we learned the indirect method, and that is what I think like 99% of businesses use to prepare a cash flow statement. But proprietary funds, you have to use a direct method, which for our purposes is actually easier. You don't have to go into all that, the differences on the balance sheet, and do I add it, do I subtract it, how does that work? It's just like, we spent this, so it's a cash flow out. This came in, so it's a cash flow in. So to me, it's a little easier to do a direct. The main reason corporations don't do them is because it's very informative. And it tells competitors things they might not want competitors to know. But government, you want to be transparent. You want to disclose how that cash flowed. So they do direct method, right? So if you think about the reasons behind all these, government financial statements do make a lot of sense. So we're trying to disclose more, so we use the direct method. Also, this big distinction, interest and dividend revenue is in the investing section for proprietary funds. That's okay. The reason they're in commercial financial statements, the reason they're there is because they're coming from short-term assets like securities that are being traded, right? So you put that there, but organizations don't do that. I mean, governments don't do that. Interest payments, right? So debt service, when you're paying interest on a loan, that's where it's getting divided into those two categories. Is this for operations or is this for a capital asset that I bought? Why do we need to know that? Because we need to net that out of the capital asset. At a corporation, they don't keep that, so it's just interest. Here's our interest expense. And they don't really want you to know how much you borrowed for this or that machine. But here, we match that stuff up. It's more transparent. Fixed asset transactions are in capital financing. Reconciliation starts with operating income instead of net income. So there's a few differences. That's where we'll stop right now. We'll come back and talk about fiduciary funds.